Welcome back, students who are taking financial accounting, and in this series of videos we are working on the assigned homework problems from the digital study guide for chapter 5, the exercises from group B. And before we get started, I decided to, let me get my pen here, I decided to page down, I decided to put in this here slide, and I'll be putting this in at the very beginning of every video from now on instead of explaining it, and I'll just read it real quick. It says, note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help you if you do not understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you do not understand the concepts, then either email or speak with an instructor to help get that understanding. Okay, so in the last video, we worked on problem 28B, and that was using the FIFO method. Okay, when I was working through the problem, I also did I also kind of explained about how to go about using the LIFO method. So now when we're looking at problem number 29, we're actually using the same data, all right, because it says refer to that, 28B. However, instead of using the FIFO method, we're going to use the LIFO method. So go back and watch the previous video. If you didn't understand, in order to get a better understanding of using the FIFO method and the difference between using the FIFO and the LIFO method. So in this video here, I'm not going to go through that explanation as to the differences. I highly suggest that you do watch that video and understand the differences. It clarifies the concept in your head. So in this video, I'm just going to actually work through the problem using the LIFO method. So let's see here. We're looking at dated 3/1. We have a balance of 6 units at $100 each, which means we have a total of, so our total cost or inventory cost is going to be 600. I'm going to kind of like put my purchases here and my cost of goods sold here. Okay, limited amount of space. Okay, so we're starting out with a beginning balance of 6 units at $100 each. Okay, then on 3/7, we purchase 8 at 108, and that means 8 times 108 is 864. So now our total inventory, all right, since we're using a perpetual inventory, we're keeping track of exactly what we have in inventory. So on 3/7, we have 6 at 100, which is $600, and then we have our purchase of 8 at 108, which is 864, which means now we have a total of 1464 in our inventory. Okay, so now on 3/11, we're making a sale. Okay, so we're selling 10, right? So if we're selling 10, we have to take 10 out of our inventory, and since this is perpetual, all right, and since we're using the LIFO method, remember LIFO is last in are the first ones out. So the last ones in are these 8. So we have to get rid of 8 of those, and we still need 2 more in order to make our 10. So out of the 6, we have we'll take the 2 out, and we have 4 left. So that means at this point in time, we have 4 at 100, and our inventory value is $400. Okay, so that takes care of that sale. Now on 319, we purchased 13 more at 112, and that totals 1456, 13 times 112. And so we have 400 at 4 at 100, or $400, and we have 13 at 112, which is 1456, which means our inventory value is 1856 as of 319. And then on 328, we sell 9 more. Okay, so if we're using LIFO, right, last one's in or the first one's out. So we need to get rid of 9. Well, the last ones in are these 13. So we take out 9, and that means we still have 4 remaining. So we have our 4 at 100, which is 400, and 4 at 112, which is 448. So our inventory value is 848 at the end of March 28th. Okay, so that's how we keep track of the of the inventory. Okay, now we have to make journal entries. Right, so I'm just going to make journal entries and then erase them. I'm going to make them up here in this area. Well, actually, I'll make them down here at the bottom here. I'll make the entry, and then I'm going to erase it in order to be able to make the next entry. Okay, all right. Since we already have, we have our beginning balance on 3.1. We don't have to do anything with that. But now we on 3.7, we're purchasing 8 units. Okay, and we're purchasing them on account. So when we're making a journal entry, am I affecting cash? No. Am I affecting accounts payable or accounts receivable? Yes, I'm affecting accounts payable because I'm buying these 8 on account. I mean, that's what the setup of the problem says. It says here, Underwater World uses the perpetual inventory system. The sales price is $185 each. And let's see here. Right. Let's see. Use perpetual in the sales price. Following. Refer the data. Assume right. Here it is. Assume that all purchases and sales are on account. So both our purchases and our sales are on account. So we're purchasing on account, so that means we're going to credit our accounts payable for the 864 from 3.7. And of course, when we're buying them, where are we putting them? Well, we're putting them in inventory. So our entry is 864. A debit to inventory for 864 and a credit to accounts payable for 864. All right, the next entry, pause the video if you have to and write it down. All right, we can. That's the advantage of video. So on 3.11, we're making a sale. So we're selling 10. Well, if we're selling 10 at 185 and it's on account, that means we're going to debit our accounts receivable for 1,850. That's 10 times 185, right? We're selling 10 times the 185 as 1850, and we're going to credit our revenue account, or sales revenue, for 1850. Right? Next entry. Now the next entry, remember, whenever you make a sale, you also have to make a second entry to take it out of inventory, right? So that was the entry for the sale, but now we have, since it's no longer in inventory, our inventory is decreasing. So we're going to credit our inventory, right? And how much are we crediting the inventory for? Well, we have, let's see, we had 8 at 864, all right? And we had 4 at, I'm sorry, we had 2 at 100. Okay, let me point it out here. When we're selling these 10, remember we're taking 8 out here, so we're 864, I'm sorry, 864. We're taking 8 at 108, which gives us 864. Okay, and then we're also taking 2 more at 100, so that's an additional 200. So that means we're going to credit our inventory for 1,064. And of course, since we're taking it out of inventory and debits have to equal credits, we'll debit something else. And where are we putting that? We're putting that in cost of goods sold for 1,064. Okay. So that's the second half of that entry for 311. And remember, whenever you make a sale of something out in inventory, you have to take it out of the inventory. Okay, so then on 319, again, all we're doing is just repeating here what we're doing from 3.7 and 3.11. Purchases, we're going to credit our accounts payable, and we're purchasing 13 at 112, so that's 1456, and we're debiting our inventory for 1456. Then on 328, we're making a sale, so we're debiting our accounts receivable for the amount of 1665. That's 9 at 185. 185 times 9 gives us 1665. Okay. And we're crediting our revenue for 1665. And since we made a sale, now we have to take it out of inventory, right? So we're crediting our inventory, and we're crediting our inventory in the amount of, let's see, we're taking the 9 at 112, so it's 112 times 9, which gives us 1,008. So we'll credit inventory for 1,008 and hit our cost of goods sold for 1,008. Okay, and that's it for this problem. Right? Okay, so I hope you followed that. Let's see here. Let me look down here. And again, the next one will be on average costing. Oops. Okay, yep. So the next problem will be on average costing. So, again, I highly recommend that you watch the problem 5-28B. Okay, and then this here is the 29B, and of course in the next video I'm going to highly recommend that you watch that one and this one so that you understand the differences between each one. Okay, like I said, 28B, I explained where you're taking things out of in comparison to FIFO versus LIFO, and that's what these were two about. But the next one will be average costing, which works in a slightly different manner. So I'll see you in that video for that.